You think China's property market is recovering? Think again. While Beijing floods the media with optimistic headlines and developers stage elaborate press conferences announcing record sales, the reality on the ground tells a completely different story. This isn't just another economic slowdown. This is a full-blown crisis masquerading as a recovery, and if you're not paying attention, you're about to miss one of the biggest economic deceptions of our generation. Before we dive into the details, if you find this content valuable, please hit that like button and subscribe to the channel. Your support helps us continue bringing you the real stories behind the headlines. Now, let's expose what's really happening in China's property market. Let's start with the numbers that Beijing desperately wants you to ignore. As of late 2025, China has an estimated 80 million unsold or vacant homes sitting empty across the country. 80 million. To put that in perspective, that's enough housing to accommodate the entire population of Germany. The completed but unsold inventory reached 762 million square meters by August 2025, and it's still climbing. This isn't a temporary blip. This is structural oversupply on a scale the world has never seen before. The Chinese government keeps talking about stabilization, about green shoots, about recovery being just around the corner. But here's what they're not telling you. The time needed to clear unsold new homes across China's 100 major cities has reached a record high of 27.4 months. That's more than 2 years of inventory sitting idle. The normal healthy range? 12 to 18 months. We're not even close to normal, and we're moving in the wrong direction. Property sales from the top 100 developers plunged 36% in November 2025 compared to the previous year. Let that sink in. These are the biggest, most established players in the market, and they're hemorrhaging sales at a rate that would make any Western CEO break out in a cold sweat. Some analysts are even predicting that a stunning 80% of developers and construction firms could exit the market entirely in the coming years. This isn't consolidation. This is extinction. Now Beijing will point to their Tier 1 cities Beijing, Shanghai, Guangzhou, Shenzhen, and claim victory. They'll tell you these markets are stabilizing, that transaction volumes are up 15 to 20% year over year. And technically they're not lying. But here's the critical context they conveniently leave out. While new home sales in these elite cities might be showing some life, second-hand home prices continue to slide. That polarization between primary and secondary markets? That's not a sign of health. That's a sign of manipulation. The government has essentially been propping up new home sales through aggressive policy interventions, mortgage rate cuts, lower down payment requirements, eased purchase restrictions, while the real market, the second-hand market, where people actually vote with their wallets based on genuine demand, tells a completely different story. It's like painting the front of a house while the foundation crumbles behind it. But the real smoking gun in this fake recovery story is what's happening with China Vanke, once the country's largest home builder by sales and considered one of the financially sounder developers in the entire market. In late December 2025, Vanke narrowly avoided defaulting on a 2 billion yuan bond. That's $284 million. They also sought to delay repayment of another 3.7 billion yuan, $530 million of debt, due on December 28th, with bondholders reluctantly agreeing to push the deadline to February. Now, here's where it gets really interesting. Vanke isn't some over-leveraged speculator like Evergrande that got caught with its pants down. This is a state-backed developer with deep connections to the Shenzhen government. Shenzhen Metro Group has already provided more than 29 billion yuan, $4 billion in shareholder loans to Vanke this year alone to help with debt repayments. And it still wasn't enough. By the end of September 2025, Vanke reported 60 billion yuan of cash against short-term debts of 151 billion yuan. That's a cash-to-debt ratio that would make any financial analyst's stomach turn. If a company like Vanke, with all its government backing and supposed financial prudence, is teetering on the edge of default, what does that tell you about the smaller, private developers? It tells you the entire system is fundamentally broken, and no amount of government spin can hide that fact. Let's talk about the developer consolidation that Beijing keeps celebrating as a sign of market maturity. The number of developers achieving annual contracted sales of at least 100 billion yuan, $14 billion, dropped to just 10 in 2025, down from a peak of 43 in 2020. That's a collapse of over 75% in just 5 years. Among those top 10 survivors, only one China Vanke holdings actually reported year-over-year growth in sales. 9 out of 10 are shrinking in a supposedly recovering market. This isn't creative destruction leading to a healthier, more efficient market. This is systemic failure, and the survivors aren't thriving, they're just dying more slowly than their competitors. Now, the Chinese government loves to talk about their comprehensive policy, support the 300 billion yuan lending facility for state-owned enterprises to buy unsold homes, the 4 trillion yuan whitelist program to fund unfinished projects, the various mortgage rate cuts and down payment reductions. On paper, it all sounds impressive. In reality, it's been spectacularly ineffective. That 300 billion yuan program to buy up unsold inventory and convert it into affordable housing, it's only managed to address 4 to 6% of the overall completed housing stock. The geographic mismatch makes the whole scheme almost useless. Most of the unsold housing is in lower-tier cities where populations are actually declining and demand for housing is collapsing. Buying up apartments in ghost towns and calling them affordable housing doesn't solve the fundamental problem of oversupply in the wrong locations. And the whitelist program that was supposed to ensure completion of unfinished homes? Last reports indicated that around 4 million homes had been completed under this program. Sounds good until you realize that Nomura estimated about 20 million pre-sold homes remained unfinished as of late 2024. We're not even a quarter of the way through the backlog, and momentum is already stalling. Here's the part that should keep global investors up at night. The property sector historically contributed about 20% of China's GDP growth. Real estate development, construction materials, furniture, home renovation, financial services tied to mortgages, all of it adds up to more than a quarter of total economic activity in China. When this sector collapses, it doesn't just hurt developers and home buyers. It creates a cascading failure across the entire economy. Home prices have fallen 20% or more from their peak in 2021. That means hundreds of millions of Chinese households have watched their primary source of wealth evaporate. According to Macquarie Group, roughly 85% of the price gains that underpinned household wealth creation have disappeared since 2021. The negative wealth effect from this is absolutely crushing consumer confidence and spending. Young buyers are opting to rent rather than buy because of job insecurity and modest income growth concerns. Makes sense, right? Why would you bet your life savings on an asset that's been losing value for 4 straight years, especially when you're worried about keeping your job? But when an entire generation of young people in the world's second-largest economy decides that homeownership is a losing proposition, you've got a demographic and economic crisis that will echo for decades. The investment side of the equation is equally grim. Property investment fell nearly 16% in the first 11 months of 2025. Real estate development investment posted the largest year-over-year decrease since 2004. New construction starts have contracted by more than 20%. Developers are prioritizing completing existing projects over starting new ones because they're terrified of adding to their unsold inventory. That sounds prudent, but it means the pipeline of future projects is drying up, which will cost jobs, reduce demand for construction materials, and further depress economic activity. Now, let's address the elephant in the room. Some analysts and even some government officials are starting to acknowledge that we're not looking at a quick V-shaped recovery. Economists at Morningstar say home prices are unlikely to rebound until 2027 due to excess supply. Morgan Stanley says restoring confidence in the property sector may take years. Some independent analysts are even more pessimistic, suggesting it could take 30 to 40 years for China to fully recover from this crisis. Think about that. An entire generation could spend their working lives dealing with the fallout from this property bubble. The Chinese government's own Central Economic Work Conference in December 2025 made property market stabilization a top priority, emphasizing the need to control new supply, reduce inventories, and optimize offerings. That's bureaucratic language, for we have no idea how to fix this mess, but we need to look like we're doing something. The conference also noted that real estate instability and local government debt remain the primary challenges to China's economic growth. That's an admission that even with all the policy tools, all the state resources, all the government intervention, they haven't been able to turn this ship around. Here's where the story gets even more troubling. Beijing has started censoring social media posts deemed doom-mongering about the real estate market and housing policy. They've blocked the release of once publicly available sales data. The Chinese government has resisted opening its books to provide a clearer picture of the financial system's true condition. When the International Monetary Fund tried to assess China's banking system, they reported that access to critical data was restricted and that authorities didn't share institution-specific exposures to property developers. This isn't transparency. This isn't the behavior of a government confident in its recovery narrative. This is information control designed to prevent panic and maintain the illusion that everything is under control. But you can't solve a problem by pretending it doesn't exist, and you can't restore market confidence by hiding the truth. The banking system remains the biggest unknown in this whole crisis. Chinese banks have withstood the fallout from developer defaults so far, but analysts are increasingly worried about a slow-motion crisis unfolding. State-owned developers that can't generate adequate cash flows are being kept alive by continued bank lending. That's not a recipe for recovery. That's a recipe for prolonged stagnation and eventual banking sector stress when those loans inevitably go bad. The IMF has warned that systemic analysis of risk in small banks is hampered by lack of publicly available data. Many of these smaller banks are considered the most vulnerable, and they're also the ones most exposed to property developers and local government financing vehicles. We don't know the full extent of the problem because Beijing won't let anyone look under the hood. That should terrify you if you have any exposure to Chinese financial markets. Alicia Garcia Herrero, chief Asia-Pacific economist for Natixis, warned at a recent roundtable that state-owned enterprises unable to generate adequate cash flows would force banks to keep lending to them. She described this as a dynamic that risks locking the system into prolonged stagnation. That's economist speak for zombie companies being kept alive by zombie banks in a zombie economy. Some of the human cost of this crisis is starting to emerge in tragic ways. Wang Linpeng, the chairman and CEO of Easy Home, China's largest home furniture retailer, reportedly died by suicide in July 2025. His death came amid collapsing revenues and rising debt at his company, and he was the fourth private entrepreneur to take his own life in just 4 months. Several of these cases involve business leaders in sectors downstream from real estate. When entrepreneurs are literally killing themselves because their businesses are failing due to the property market collapse, you're not looking at a recovery. You're looking at a human tragedy playing out across an entire economy. So, what does all this mean for the global economy? China has increasingly relied on exports to offset weak domestic demand. With falling export prices and an undervalued currency, China's export machine has remained strong, and the economy has become dependent on external demand to meet Beijing's annual growth targets. That means Chinese overcapacity in everything from steel to solar panels is being dumped on global markets at depressed prices. If you're a manufacturer in the United States, Europe, or anywhere else competing with Chinese exports, you're not just competing with companies. You're competing with an entire state apparatus desperate to maintain growth and employment by flooding global markets with cheap goods. The property market crisis isn't just China's problem. It's creating trade tensions and economic distortions around the world. Looking ahead, the consensus among serious analysts is that we're nowhere near a bottom. S&P Global projects property sales will fall to as low as 8 trillion yuan in 2026, less than half the 18 trillion yuan sales level in 2021. They're forecasting sales declines will continue, with another 6 to 7% drop expected in 2026 and primary home prices down another 1.5 to 2.5%. Goldman Sachs warned that property prices could drop by another 20 to 25% if policy support falls short. Given that policy support has consistently fallen short for the past 4 years, why would anyone expect that to change now? The Atlantic Council recently published an analysis noting that China's real estate slump is in its 5th year with no end in sight, and that as many as 80% of developers and construction firms could exit the market in the coming years as the industry permanently contracts. They conclude that even in the best-case scenario where the bureaucracy muddles through, the likely outcome is a prolonged drag on the financial system and the broader economy. Some optimists point to Evergrande finally getting delisted from a Hong Kong stock exchange in August 2025 as closure on that chapter of the crisis. But as one analyst put, delisting means no recovery of the sector. It's not closure. It's confirmation that the good days of the Chinese property market are finally over. Here's the bottom line. China built 600 million permanent buildings in mainland China. That's one building for every 2 Chinese citizens. The domestic consumer base cannot possibly absorb this oversupply. You can't export real estate. You can't ship apartment buildings to other countries. The only solution is a long, painful adjustment where prices fall until they reach levels where genuine demand returns, where developers who can't survive go bankrupt, where banks write off bad loans, and where the economy finds a new growth model that isn't dependent on property speculation. Beijing keeps trying to avoid that adjustment with stimulus programs, policy interventions, and propaganda about recovery. But you can't bail out your way out of a structural oversupply crisis. You can only delay the inevitable, and every day of delay makes the final reckoning more painful. The so-called recovery you're hearing about? It's a carefully constructed narrative designed to maintain confidence, prevent capital flight, and give the government time to manage an orderly decline. But make no mistake, this is a decline, not a recovery. The Chinese property market is broken, and it's going to stay broken for years, possibly decades. The numbers don't lie, even when the headlines do. 80 million vacant homes, 27 months of inventory, property sales down 36%, 9 out of 10 top developers showing declining sales, state-backed Vanke on the edge of default, home prices down 20% and still falling. These aren't signs of recovery. These are symptoms of a market in crisis, and no amount of government cheerleading can change that fundamental reality. If you're invested in China, if you do business with China, if your company depends on Chinese demand, you need to understand that the property market collapse isn't just a real estate story. It's a story of Chinese economic rebalancing, and it's going to be messy, prolonged, and painful for everyone involved. The fake recovery narrative serves Beijing's interests by buying time and preventing panic. But it doesn't serve your interests if you're trying to make informed decisions about investments, business strategy, or economic policy. Don't believe the hype. Look at the data. Trust the trend lines, not the press releases. That's the real story of China's property market in 2025. Not recovery, but a managed decline disguised as stabilization. Not improvement, but deterioration at a slightly slower pace than last year. Not confidence, but desperation dressed up in optimistic language. If you found this analysis valuable, make sure to hit that like button and subscribe for more content that cuts through the official narratives to bring you the real economic stories shaping our world. Drop a comment below with your thoughts on China's property market. Do you think we've seen the worst, or is there more pain ahead? I'd love to hear your perspective. Thanks for watching, and I'll see you in the next video where we continue following the biggest economic stories the mainstream media isn't telling you properly.